Maria, of course, investors, of course, want to make a social impact, and wanting to do it and put money into something is all very well, but how easy is to measure outcomes?
It is difficult. It is, and I'm sure some people know that much better than I. I think for us sitting in this sort of in the stewardship team, when it comes to the S, you can look at, if you look at it from diversity, human capital management, you can get the data. Diversity I think is easier. It's more clear cut, slightly.
That's arguable. I think people can look at representation data and say we've achieved diversity, but whether you've actually created an inclusive workplace or an environment where it can continue over a longer term, that's probably where it becomes a bit more subjective.
Absolutely. And I think, and that's the better outcome of the two. If you look at health, for example, it's very difficult to say what are you measuring? Are you measuring if they have a good employee policy? If you look at the US, you could say, well, look at their insurance policy that they're providing for their healthcare insurance policy for their employees, and that makes it quite difficult. So we have an internal that is also available on our website, an ESG score, ESG plus T score, and there what we look at, we'll look at diversity and then look at board level, executive level, managerial level, and overall as employees. But that's sort of how far we can get when it comes to the S. If you want to include something else, it's really difficult, especially because our score, we wanted to be able to be applicable to all the holdings we have. So it's sector agnostic. It's crude in a sense. I think it's an excellent initial tool, but it is quite crude. But it is the long-term impact of it, or the effectiveness of, for example, diversity. It's very easy to have a.
Can I add to that as well? I think as well from a listed equities perspective, some of that data might be difficult for us to have as investors. And then again, that's where the engagement element comes to mind. So we found microlenders in India, for instance, who know their customers so intimately that they've got very low non-performing loans. And a big part of that is because the loan officers down the street. So there's a community thing where someone doesn't want to be on the outs with someone who's just down the street. And so that intimate knowledge is something where we can actually push these companies to go a step further, not just in measuring how many microloans they brought out, but because you know these people intimately, can you also evidence what they were able to do with it? And what outcomes came out of it, whether it's improving their livelihoods or growing their businesses, etc. And that's something that's going to take a while as these companies now also get their heads around, let's go a step further in measuring this. And I think that's one of the biggest pieces of work that asset managers can do in trying to get better clarity and better measurability of social outcomes.
Absolutely. I think for sure.
Okay. Jessica, how can government or whoever persuade more investors to make social impacts? Is it about maybe regulation or offering tax breaks? What's the answer here?
Yeah, so I guess how do investors do more for social? So I think there's a whole, it's a complex space, and of course there's no one single answer. We need lots of different actors to do lots of different things. Yes. I think number one is really encouraging asset managers really putting their first foot forward in terms of prioritising health and social issues more broadly within their stewardship approach, and ensuring that their sustainability teams have the resource to really do that in a meaningful way. So it's fantastic that Maria's role is really partly focused around health. I think Elgin have kind of really shown leadership in this area on that point, but we'd love to see more asset managers really kind of prioritising health and social issues. So I think that's number one. Number two, I think is really around asset owners. So and we were having a few conversations earlier on this. Asset owners have a really important voice and can be really powerful in encouraging their managers to to really be bold on social issues and to start taking them more seriously. So asset owners can be asking their asset managers and ensuring that they're thinking about health and social issues in the way that they're allocating capital, the way that they engage with the companies that they're invested in, and in the way that they use their sort of proxy voting abilities. So there's a role for asset managers, there's a role for asset owners. And then I think there's also a role for data providers and of course regulators. So data providers at the moment will have all seen examples of where British American Tobacco has ended up at the top of a sustainability index. And that can be for no other reason than the fact that they've just simply not included health metrics in those sustainability indexes and the way that they calculate them, which is an enormous omission that is commonplace at the moment. So we're trying to actively engage with some of the leading data providers to think about how they better incorporate health within those indexes. And then finally, of course, the role of regulation. So we want to work with regulators to firstly ensure that companies are encouraged to better report on health and social issues, which we know is typically, the reporting in those areas is typically poor. So we want to strengthen kind of legislation in that area. And then the other thing is around really making sure that the rules and incentives that drive the behaviour of investors are geared in the right direction to enable, support and reward investors who do the right thing and incorporate social factors into their stewardship approach.
Thank you. Dabika, what challenges is the emerging world facing while tackling climate change from a social point of view?
Yeah, I mean, I think it was already touched on. The biggest challenge is that people are decoupling climate action and environmental solutions from the social element.
Okay.
And so you have very inequitable allocation of capital as far as those two topics are concerned. And I think that's, not productive, because clearly, as far as, it's probably emerging markets that are disproportionately negatively impacted by climate action. And that's because of their proximity to polluted air or water, and also the lack of infrastructure that they have to withstand a lot of climate-related, NatCat or natural catastrophe activity. And so from that perspective, it doesn't make sense to essentially exclude the better part of more than half of the world population from the conversation as far as climate action is concerned, and to also ignore the impacts of climate action on those communities, especially given that a lot of the raw materials are sourced in emerging markets, for renewable energy, for instance. So you have to really take it holistically, and I think a big part of the challenge has just been emerging markets being ignored from that perspective. And capital not going into social issues as far as emerging markets are concerned. And I think that's actually got a negative impact as well. That creates a negative impact for the climate action objectives as well. And that's probably something that needs to be changed as far as deploying more capital towards social related issues, not just from a public perspective, but also private as well.
Thank you. Okay, guys, anybody have any questions for our panel on what we've just heard? Okay, yeah, there's a gentleman at the back.
Thanks very much for that. It was very interesting. My question is about sugar. No Share Action has been a regular campaign on sugar. And at the same time, the government produced that food safety bill and took mandatory sugar limits, I think, out, something along those lines. So it seems to be odd. It seems to be sort of a strange situation where you've got a government deciding not to pursue a particular policy, but investors being encouraged to pursue a particular policy. And so my question is about legitimacy. Is it for people with money to lead social action, or is it people with owners to lead social action?
Yeah, happy to take that one, and thank you for the question. And I'm sorry I didn't hear bits of it, so I'll try and answer as best I can. So this issue of sugar, so our Healthy Markets campaign doesn't just focus on sugar. Our Healthy Markets campaign is aiming to improve the diets of all people living in the UK, whether that be about reformulating products to reduce sugar or any of the other many measures that food companies can take to support their consumers to stay healthy. So we work with food manufacturers and food retailers, and we encourage them to shift the proportion of their sales towards those healthier options that they have anyway. And they can do that in a whole number of ways. So whether that be through reformulating their products, through shifting their marketing towards those healthier options, thinking about how they position things in store and where they put those healthier versus less healthy products. So there's a whole range of things that companies can do. And what we emphasise in our work is accessibility. So we know that, for example, obesity, which Maria highlighted earlier, we know that this is an issue of poverty in essence. So in areas of lower income, you see much higher levels of childhood obesity. And so it's really important that we're working with all of the food companies who ultimately shape and influence the food environments and the food that people have access to make sure those healthier options are as available, accessible, and really the default option for people. So this isn't about making low sugar alternatives that are going to be heavily kind of promoted as the healthy thing. Particularly, that's one approach. But actually what we really advocate is making small changes to core products. And that's where we're going to see a real impact. So that means that consumers aren't having to consciously opt for the healthy option to make that conscious choice or decision, but rather the food and the products that they're presented with on a day-to-day and that are put in the spotlight are the healthier alternatives and the healthier options for them. And in terms of regulation, so actually we're seeing that regulation is generally speaking, although there's been some disappointing news lately, but generally speaking it's going in the right direction. So in the last few years we've had the sugary drinks industry levy, so that's a tax on sugary drinks essentially, and that's had an enormous impact in the amount of sugar we're consuming as a population through sugary drinks. So we've seen the government take really strong action on that. We've also seen announcements around reducing the amount of advertising that companies are able to do in certain positions in store or at certain times of the day. We've seen TfL ban junk food advertising on all of their kind of bus stops around London. So we've seen some really positive moves in terms of regulation. That's in the UK. There's of course lots of regulation in other places around the world too. And actually there's a really interesting stat which shows, which talks about there being more sugar taxes now than there are carbon taxes around the world. And it's this kind of regulation that is really giving investors even more kind of ammunition, I suppose, to want to focus on this as an engagement topic with the food companies that they are invested in. We know that when food companies really make a concerted effort, they can shift sales and consumer purchasing towards those healthier options, and that de-risks them from incoming regulation that might be constraining going forward. So I don't know whether that's, I hope that's answered your question at least.
If I can just add to that too. So as investors, we were quite a significant group of investors that fed into the UK food strategy from last year already, and we asked the government to take certain actions. One was mandatory reporting, for example, when it comes to their product on high sugar, salt and that. And so I think it's concerning the question where you highlighted the legitimacy of it. I think we were very much pushing the government to take action, and a lot of us were very disappointed to see what strategy that came out a couple of weeks ago. So I think there's a lot of support from us as investors to the government to take that action, both when it comes to reporting, but also, for example, marketing, whether that be on the telly or if it is in the shops. And in the engagements that I've been involved in with both UK, US, and emerging market manufacturers in food and beverages, they are certainly listening and are willing and wanting to make changes to their product portfolio, sorry. And
Okay, good. We're at time now. Well, maybe we have one more question if anybody has one. I guess there's a hand up at the back there. Just say who you are and you represent.
Hi, can you hear me? Hi, my name is Dawn White and I work for T-Non, which is a partner of Portfolio Institution. And we are an organisation that is driven to drive race equity with the organisation that we work with, over 120. And we talked about diversity and inclusion very briefly, and I've heard mostly about health, but of course, race equity and health are connected. As we saw, disproportionately Black, Asian, minority, ethnic professionals were affected by the pandemic. And so what I would ask all of the panel is, how do we get investors to drive race equity using their voices, and what is the one thing that all investors can start doing today to drive race equity?
I think that's an excellent question. For us, one of the main things that we did was launch a diversity and inclusion fund at the end of last year. And a big part of it is that we realized, especially following the pandemic, where, as you correctly put, ethnic minorities and women have been disproportionately impacted, as well as social justice movements as well, that there was clearly systemic racial issues across many industries, political, industry, etc. And also, in the work that we did in creating that fund, we found that a lot of companies looked good at top level, at board level. There's a lot of window dressing happening from that perspective. But when you actually dug down to, whether it's organic promotions of, ethnic minorities or women, whether it's inclusive work environments, gender pay gaps, ethnicity pay gaps as well. That's where things tended to fall apart. And so our approach to the fund was really to create one where we could actually invest in companies that are not just tackling the high-level diversity, but are also evidencing the policies and processes in place to help attract and retain diverse talent over time. And there's also been a number of studies that have to some extent shown that greater levels of diversity have resulted in greater performance. Now, it's difficult to have a cause and effect conclusion based on that, but I think what it shows that it couldn't hurt. And it's something that a lot of investors should really start thinking about as far as investing in companies that are tackling racial and gender equity, whilst also delivering for the companies for the communities that they serve. And I think more importantly, it's not just the nice to have, it's actually becoming good business. And that's because you are seeing demographic shifts. So women and ethnic minorities are increasing their spending power. They are becoming more wealthy. Women, for instance, is estimated to hold about 60% of the world's wealth by 2030. And so there's actually a good business case for having actual work environments and having institutions that better reflect the communities that they serve. It's the only way you can keep up to date and up to date with the evolving trends of your customer base. And I think that's what we took a more focused view in trying to invest in companies that are doing that. But then also in the background, just across the firm, we're also engaging companies to be a bit more explicit about what their stance is on racial equity and gender equity within their firms. So it's not just about how they look, but what's the strategy to maintain high levels of diversity or further improve it over time. And that's that engagement piece, again, that keeps coming up, which also remains important, just to ensure that outside of companies that are best in class, the companies that are falling behind, we're also trying to push them to do better from that perspective. And again, it's probably a long-term view as well that companies need to take. So not just poaching from other companies, but also growing the pipeline and also attracting talent from a young age. And even if it's engaging with communities before someone is in a workplace situation where at school they're thinking about, actually, I can go into the healthcare industry. Actually, I could go into finance. It's things like this that take a long time, but it's something that companies also need to invest in. And that's some of the work that we're doing in trying to recognize and place capital behind companies that are doing that more effectively.
If I can,
Very quickly, yes.
yeah. So I think, I hats off to what you've been able to do, and we haven't. I think we only have scratched the surface. But what we did following the murder of George Floyd was that was the real input for us. We've talked about, we need to look at diversity in a different way. But that really was, we really need to do something, whatever type of data is out there. So we managed to get hold of something called assessed ethnic diversity data and screened the I think about 500 largest of our companies and wrote to them and said, we at least want to see at board level one ethnically diverse person and that was 2020. If we don't see that, by 2022, we will be voting against your chair. That's the bare minimum. And I think it is a start. It's a small start, but I think it is a start, and it's signaling to companies we are going to look at that. And that goes back to, I think, the fact of raising it as a topic in your engagement with companies and saying, well, if you're not doing anything, even if it's only at the top level, we're actually going to use our shares to vote against you. And that's very clear in our rationales that are then publicly available. Why? It's not just, it could have been anything. No, it's written clearly why we have voted against you.
Gotcha. Okay, thank you. The big Jess, Maria, thank you very much for your time and sharing your views, of course. Thank you guys for your questions. We're going to have a small coffee break now, so we'll come back at about 11:30. That'd be great. Thank you. Thank you, guys.